Hey everyone, Clayton Boone here for Austin Asset, and thanks for joining in on our Authentic Advice video series. Everyone knows that over time, the ups and downs of the financial markets can really change the profile of your investment plan. But what that means for you is that at times you can actually find yourself overexposed to risk assets or potentially underexposed to growth assets, both of which can have a detrimental impact on the achievement of your long-term financial goals. So what I want to do is just take a couple minutes to explore two approaches to rebalancing, as well as point to one of those two that we do here at Austin Asset. Stay tuned. Welcome back, everybody. We're going to be discussing two different approaches to rebalancing, and what those are is just the periodic rebalancing approach as well as the tolerance band rebalancing approach. And regardless of these two approaches that you choose, the most important thing to do is just to commit and continue on with doing a rebalancing approach. And so whenever we discuss these approaches, I first just want to start out with the periodic rebalancing. And the reason being is that this is really a simple way to do rebalancing, in that you just pick an arbitrary time frame or date and you analyze your portfolio and you determine which asset classes are out of balance and you rebalance back. It's as simple as that. Now, the problem with the periodic approach is that if the market were to move significantly in between your rebalancing dates, you can once again find yourself overexposed to risk assets or potentially underexposed to growth assets. Once again, not an ideal outcome. The other way to do rebalancing is what we call the tolerance band method, and that's what we do here at Austin Asset. Now, what is the tolerance band method? Well, the tolerance band method is a little bit more involved. What it does is it starts out with a pretty formulaic approach to rebalancing, and it's monitored pretty much almost every day to make sure that you're always focused on your asset allocation. And the way that it does that is it determines in advance the amount that it's willing to let the asset classes kind of grow or wander, maybe by a certain percentage, before it rebalances. So as you can see, as opposed to taking a time-based rebalancing like what you see with periodic rebalancing, it takes more of a market-based approach, and that it rebalances as the market moves. And so what you end up with as an investor is a much more consistent exposure to not only just the asset classes that are in your asset allocation, but the amounts that are called for in your financial plan. So those are the two approaches to rebalancing: your periodic approach, as well as your tolerance band approach. Once again, regardless of the approach that you choose, it's just really important that you stick with one of them. If you're starting to think back that it's been a while since you have rebalanced and you could use a second opinion, don't hesitate to give us a call here at Austin Asset. We'd love to help you. And once again, from your friends here at Austin Asset, stay safe, stay connected.